Good. Well, good afternoon, everybody, and welcome from Trotec South Africa and Trodat customers that are viewing at this time. So I just want to give a little bit of an intro on the South African economic situation, as well as some tips and tricks in terms of how you can rapidly increase your profitability in times where I think we need it most. So I'm just going to give a macro being a total overview of the South African economy as I see it, and I just have a couple of slides that I want to take you through. So we are now, I'm not sure if you can call it a post-corona effect, but we certainly are post-lockdown effect. And after doing some research, the experts, economists, if you will, have come up with 5 major factors that are in play from our country's perspective that need to be dealt with. The first one, of course, is the pandemic itself. So COVID-19 has overtaken our lack of sustained electricity, taking over the lack of sustained electricity supply as the chief risk in the South African economy. With recent holiday lockdowns now relaxed, the forecast growth for our country this year has gone down to 0.5%, so very, very low. Of course, as a result of that, unemployment has increased to greater than 40%, and now we've had another 500,000 or 600,000 matriculants that are not going to go to tertiary education that have added to the unemployed burden. But certainly, the country needs a proper rollout of the vaccinations. And if this can be done, and if the infection and death rates can be brought under control, it will be a goal changer. So really factor number 1 is the pandemic itself. The second relates to fiscal measures. Fiscal measures being the rate of interest that we are required to pay. So the Reserve Bank that sets the interest rates have reduced the repo rate. The repo rate is the interest rate that the Reserve Bank charges to the commercial banks. So they've reduced that lending rate by 3%, or they call it 300 basis points, to 3.5%. The bank's lending rate is now reduced to 7%. And so from this reduction in lending rates, one has seen an increase in activity in terms of the buying of houses, motor vehicles, and what have you, because to borrow is cheaper. And if you are able to afford it, you are in a position to buy an investment. The third one is that the economy has been suffering, stuttering along from this, but there is still room for about 0.25% interest rate cut, which will further ease lending. But inflation remains under control, and the Reserve Bank is doing a great job, in my opinion, of between 3% and 6%, the inflation rate, currently around 4%. The third factor is commodity prices. South Africa being largely a minerals and metals economy, we are exposed to commodity prices. Metals and minerals for exports and oils for imports. So weakening rand has been good. The 25% weakening of the rand has been good for the dollar. Our minerals are sold in dollars, so platinum, gold, palladium, the country is benefiting from that. But the other side of the equation is anything that is imported, whether it is commodities, whether it is stamps, whether it is lasers, whether it's imported motor vehicles, is going to cost more. But certainly palladium, platinum, gold, diamonds, exported in dollars, the country has benefited from that. And so that's a good thing. The debt monster, regrettably, the government has had to lend to be able to fund the economy as it has been in contraction. But regrettably, the national debt levels are increasing, and this can make or break our economy. The recent budget deficit to GDP was negative 16%. Put it another way around, that the government proposes to spend 16% more than the tax revenue it is going to gain. And this is going to push the gross GDP debt. GDP is gross domestic product, which stands for the total value of goods and services that the country produces, but it's going to push the debt ratio up to 82%, which is really getting into the very serious range. And so the country has a lot of debt that it has to service, pay interest first before it can go to stimulating the economy. And the downgrading of South Africa by agencies to junk status makes the cutting of debt even higher. And then the last component is Eskom. Of course, we are living with daily blackouts. And so the load shedding is back, improving. I'm not sure, it's up and down. But the debt levels are not capable of being reduced from the present revenue streams. But there is political reticence to allow other green energy service providers to cut into the grid. The government has to certainly make changes in that regard. So those are the 5 factors, I think, that the state, the country, which ultimately runs down to the individuals, has to be dealt with. So let's talk about businesses in general. So business in general, you have to say to yourself, well, how do I actually, given the reduced business that I've got, how do I increase my profitability? And so there's a simple technique that I want to take you through. I'll call it the magic 1%. If I had to say to you, if you were able to increase your selling prices by 1%, if you were able to reduce your cost of goods that you purchase by 1%, and if you were able to reduce your expenses by 1%, how much better off would you be? Logically, you would say, well, I'm going to be 3% better off. That's not correct. And I will demonstrate that in a moment, because there is what is known as a multiplier or compounding effect of the benefit that you have generated. So if one looks at a simple income statement, sales less cost of sales will give you gross profit, less your expenses will give you net profit. So if our example, we assume that we have sales of 100 Rand, we have cost of sales of 70, cost of goods will give you a profit of 30, the 100 minus the 70. Alternatively, a gross profit percent of 30% of sales. If we have expenses of 20%, will give us a net profit of 10, and of course, a net profit as a percent of sales of 10%. Quite straightforward. So what happens if we do what I said earlier on, 1% better on sales, 1% less on cost of sales, and 1% less on expenses? This is what happens. Sales goes from 100 to 101. Quite straightforward. Cost of sales reduced from 70 to 69.3. Again, no magic there. Gross profit then goes up from 30 to 31.7, which is the effect of the higher sales and the lower cost of sales. So your gross margin or gross profit percent increases to 31. But voila, you have a 6% increase in your gross profit as a result of the compounded effect of the gain in sales and the reduction in costs. The situation gets even better if we reduce our expenses by 1% from 20 to 19.8, which then increases our net profit situation to 11.9. So all of a sudden, our net profit as a percent of sales has gone up to 12%. But your profit has gone up from 10 to 11.9, or 1.9 increase, or, wait for it, a whacking 19% increase. So isn't that magic? 1% increase in sales, 1% reduction in cost of sales, 1% reduction in your expenses will give you a 19% growth in your profitability. However, the maths becomes even more exciting if you increase the number. So let's take an example of doing exactly the same exercise, but using a 3% growth in sales, an equivalent percent drop in cost of sales and expenses. Let's see what happens. My example as before of sales of 100, cost of sales 70, profitability of 30 with a GP percent of 30%, minus your expenses of 20 will give you a gross profit of 10, or a net profit of 10, and a net profit percentage as a percent of sales of 10%. Let's grow the sales by 10%, by 3% rather, grows from 100 to 103. let's assume we can buy 3% cheaper, which reduces our cost of sales from 70 to 67.9. And here we have an increase of gross profit from 30 to 35.1, which increases our gross profit percentage to 34%, which is a 17% gain. We reduce our expenses by 3%, and all of a sudden our net profit jumps from 10 to 15.7, which gives us a 5% increase in our net profit percentage as a percent of sales. And there we have a 57%, greater than 50% increase in your profitability by affecting three techniques. One, to try and get a 3% price increase, to try and get a 3% drop in what you pay for your goods, and to try and take 3% of your expenses, fixed costs probably, out of your business. This will be the effect. So hopefully this has been helpful to you. If anybody would like a copy of this presentation, you are welcome to contact Lauren and she will forward it to you. If anybody would like me to give further small techniques on other financial tricks that can be done to improve profitability, or other general techniques that one can look at in terms of improving one's business, I would be happy to do so if you feel that would be of assistance to you. Close off by thanking you for your support to our business, to Trotec, to Trodat, and to know that we are here to help you at all times. I wish you a good day. Bye-bye.